to be hosting the discussion around the potential impact of the changes and practical plans that everyone can be thinking about in advance of the transition, and also some of the particular guidance in the Charities SORP. Hopefully you can all see a bar like this, and on that there is a Q&A box. If you have any questions, please drop them in the Q&A box and we will try and pick them up as we're going through or at the end of the session. So it seems a long time that we've been talking about this with no particular perhaps focus or urgency. And the whole process started way back in 2022 with the publication of the FRED and the changes to FRS 102. They came out in 2024, which still seems like dim and distant past. The SORP committee then really ramped up its work. It did a lot of outreach work and covered various strands of reporting, including the trustees report, and then had to incorporate the changes from FRS 102. And some 3 months after they really started work, the FRC approved the new draft SORP, which is what we are now looking at. So to bring us up to date, the SORP consultation is almost finished. It finishes on Friday. And if you have any comments or anything that comes out of this discussion, please do reply. We're expecting the final draft once all the comments have been taken on board in October, which gives us a very short window to get ready for first application. So charities with December year ends, the first year of application will be year ended 31st of December 2026, March year ends 31st of March 27, and so on. And although 27 seems a long way away, for those transitioning in December, we're already almost halfway through the comparative period, so it's not so far. This webinar is focusing on the Charities SORP, but for those who follow the further and higher education SORP, it has its own timeline. It's about 2 months ahead, but the changes are similar because the big changes are essentially part of FRS 102 periodic review. So time to start taking some practical steps. As we've said, these amendments are quite a significant change, and we will need to sort of work through them to make sure that we know whether they do affect us, don't affect us, and what we need to be telling stakeholders. So we're not going to touch on all aspects of the changes in the consultation today. We have a webinar later in the year to talk more about the proposed changes to the trustees report. But again, we will start with the potentially more challenging accounting. So we're going to run through today the threshold consultation, which is closed, the SORP consultation, which, as I said, closes, and please do put in your responses if you haven't already. We'll talk a little bit about tiering in the trustees report, but we'll cover that mainly later in the year, and we're going to focus on income recognition, lease accounting, and transition. So the regulatory changes, the threshold consultation, this was put out by the Department for Culture, Media and Sport, DCMS. It closed on the 12th of June. It's run independently with the SORP, and the figures aren't, they haven't aligned. They haven't had any discussion, one might possibly suggest, before putting both of the consultations out. So you can see on your screen the proposed thresholds. There are 21 thresholds that are listed. Those recently set by the Charities Act 2022 are unchanged, and the wording in the DCMS recommendations is often to leave thresholds unchanged or increase somewhere between the current level and a threshold based on inflation. The consultation doesn't have a 2-year roll in the same way that companies do, so essentially charities will flip in and out of thresholds. We've supported threshold increases in line with inflation, and we're now waiting for feedback as DCMS analyse those results. We wait to see what they are, and if the SORP consultation and DCMS do end up on different thresholds, we could end up with quite a complex landscape to navigate when working out what accounting and reporting thresholds meet or charities meet. So look forward to that.
Thanks, Nikki. So I suppose it's useful to remember that the statement of recommended practice is not changing the underlying UK accounting requirements, which sit within FRS 102, but it is adding guidance and interpreting them. The new SORP exposure is much longer than the current standard. And at the same time as looking at the UK GAAP changes, the SORP committee have also taken the opportunity to consider the structure of charity reporting and the contents of the trustees report. And this is where decisions in the SORP will link or not link to those thresholds that Nikki has just been covering. So one of the more significant changes is to establish the concept of tiers. The tiers are proposed at £500,000 and 15 million. Based on the data provided by the Charity Commission, there's approximately 171,000 registered charities currently. 92% of those have income less than 500,000. So it is still a relatively small proportion that sit in tiers 2 and 3. Approximately 7% will sit with income between 500,000 and income of 10 million, which is the banding that's published by the Charity Commission. And it's expected that still only about 1% of registered charities have income in excess of 10 million. Obviously, the 15 million income is in line with the Companies Act changes, but as Nikki has outlined, these current tiering bandings differ to the audit consultation that's just taken place. If we increase the threshold of Tier 1 to the current audit threshold, that would include approximately 5,500 extra charities in Tier 1 rather than Tier 2. So it would, I think, to avoid some confusion, it would make sense when the final SORP is published in the next few months if the thresholds are aligned. However, we just don't know what's going to happen here. Such that Tier 1 charities are those that are below the audit threshold. Tier 2 are those charities who are audited but small based on Companies Act thresholds, and then Tier 3 is simply medium and large charities. The current proposals do give some potential problems, challenges and contradictions. For example, differences between the audit threshold and Tier 1 would mean some small charities will have to include considerably more detail in their reporting. There remain differences between the Companies Act cash flow exemptions and the SORP, as the income figure is the only measure used to determine the tiers. And Tier 3 charities that are not large charitable companies will need to provide sustainability information, albeit this is somewhat vague in the current exposure draft. And that's obviously a requirement only required by large companies. With the increasing Companies Act thresholds, there's potentially a significant additional burden on small charities compared to companies with turnovers, which is obviously significantly greater. And I think the burden on small charities is something that will come up as the consultation responses are published. So the trustees report retains some of the wording from the previous version, including the words must, should and may in the approach to certain requirements, and it encourages many of these. So future plans and going concern remain fairly straightforward requirements, and I suspect are going to be covered by many of your charities reporting as it stands. It's only really Tier 2 that future plans going forward must be linked to the impact of the lessons learned. Volunteer disclosures were previously a must for basic detail in larger charities, which is now Tier 2, and there were should and may requirements around providing numeric detail. The change moves this basic requirement to all charities. This is likely to need some additional thought by the trustees, particularly in the smaller charities where the role of the volunteer trustee may be fundamental to the survival of the charity. Reserves is also a new requirement for all charities, with much of the previous recommended should element now being must. As previously, the charity must explain any policy it has for holding reserves and state the amounts of those reserves and why they are held. If the trustees have decided that holding reserves is unnecessary, this report must disclose this fact and provide the reasons behind this decision. But the proposed exposure draft also requires the figure for reserves in the trustees' annual report to be consistent with the accounts, and where this is not evident, a reconciliation must be provided in the notes to the accounts. The report must compare the amount of reserves with the charity's reserves policy, explain, where relevant, what steps the charity is taking to bring the amount of reserves it holds into line with the level of reserves identified by the trustees as appropriate given their plans for the future activities of the charity. The regular review of the charity reserves must continue to identify and explain any material amounts that have been designated or otherwise committed as at the end of the financial reporting period, and indicate the likely timing of the expenditure of any material amounts designated or otherwise committed at the end of the reporting period. Tier 2 charities must address impact reporting in more depth than currently required. The exposure draft requires that all trustees must provide answers to the following questions. In what way has the charity's work made a difference to the circumstances of its beneficiaries? Has the charity's work provided any wider benefits to society as a whole? The use of infographics, statistics, beneficiary and volunteer testimonials are recommended to help communicate this information to users. For Tier 2 charities, in addition to Tier 1 requirements, they must explain the impact the charity is making and must consider the long-term effect of its activities on individual beneficiaries and on society as a whole. The impact of the charity has made is arguably the ultimate expression of its performance, and charities are encouraged to demonstrate this in their report. In particular, the use of personal beneficiary or society-wide impact stories may be of value in communicating meaning. Further detail is only recommended and not a must. However, expectations of the Charity Commission and stakeholders may mean that charity management and trustees will need to give more thought to how they measure impact. The exposure draft of the SORP states that charity should include a summary of the measures or indicators used to assess performance, including in relation to environmental or social issues if applicable, an explanation of the outputs achieved by particular activities, especially when numerical targets have been set, for example, the number of beneficiaries to be reached by a particular programme, or the number of events or interventions planned as part of an activity. Information on activities, outputs and outcomes or impacts in the context of how they have contributed to the achievement of the charity's overarching aims and objectives. The report should comment on those significant positive and negative factors, both within and outside the charity's control, which have affected the achievement of its objectives, and where relevant, explain how this has influenced future plans. These factors might include relationships with employees, service users, beneficiaries, and funders, and the charity's position in the wider community. Impact reporting cannot be done by cross-reference to a separate report, something that the exposure draft permits for sustainability reporting. Sustainability reporting is only going to be required by Tier 3 charities, which is currently those medium and large by Companies Act thresholds, though there may be differences for some charities as the Companies Act thresholds have staff and balance sheet thresholds as well, whereas purely on this tier reporting we're looking at income levels. The exposure draft says that the report must provide a summary of how the charity is responding to and managing environmental, governance and social matters. However, it does not give more must requirements than that general direction. However, there is more recommended guidance. For example, the report should provide details of the KPIs used to assess progress against targets used to manage climate-related risks and realise climate-related opportunities, and a description of the calculations on which those KPIs are based. In relation to governance and social matters, reporting may include details of social opportunity, privacy and data security, board diversity and business ethics. Where the charity is already reporting on these matters, but the detail is not included, a link may be provided. Charitable companies which fall within the scope of the Companies Directors Report and Limited Liability Partnerships, Energy and Carbon Report 2018 regulations, there's a mouthful, must provide the disclosures required under those regulations. Charities in the Republic of Ireland which fall within the scope of the EU directives must provide disclosures required by those. There's also proposed requirement to talk more about material legacies in the accounts, particularly judgments over what is included as receivable. This potentially encourages more deviation from accounting policies and judgment, and charities may seek to justify treatments that are not consistent by explaining it in the report. Performance of fundraising activities against objectives has been moved to Tier 3, previously for larger charities, reducing some reporting, which can be difficult when the costs rarely match what the results of the activities achieve, i.e. a legacy fundraising campaign. However, all charities that have audited accounts will still have to comply with the Charities Protection and Social Investment Act 2016, which requires comprehensive disclosures about voluntary standards adhered to how fundraisers are trained and monitored, complaints, and how the vulnerable are protected. If the thresholds or any of the reporting elements particularly concern you, please do respond to the consultation.
Thanks, Michael. Moving on then, we'll talk about the statement of financial activities and revenue recognition. And this is just a point which I think is of change in the new exposure draft, which is hopefully of beneficial or most benefit to Tier 1 charities, which is the ability to use natural classification. So this is where we are currently. We've got receipts and payments income, receipts and payments accounts, which can be done up to 250,000, which may be rising depending on that DCMS consultation, and an introduction of this idea of natural classification for Tier 1 and then activity basis. So essentially, this is a simplification of the accounts and bringing them more in line with the sort of style of management accounts in many instances. We've talked about that Tier 1 threshold, which in my view is too low because it creates sort of a too narrow change between moving from receipts and payments to sort of full accruals accounts, activity basis, cost allocation, and all the intricacies of the SORP. So with the caveat that if you're expecting to move between bands, this may not be so useful. I think this is a plus for smaller charities. And again, do discuss this with your auditor, independent examiner, and sort of think about what that might look like. So here's an example. These are the formats that are actually in the SORP, which I think is very constructive and sort of sets out what you might expect. You can see that the change is most significant in expenditure, where you're looking at those natural categories. And as said, again, hopefully aligned to your management accounts. Where you are a charity who fully costs your allocations or your charitable activities, so you're allocating internally and as part of your sort of management processes, then this may not be of much benefit. So it's going to be something to consider, I think, for smaller charities, and it's useful to have it spelt out. But moving on now to what is probably the main event, along with leases in the SORP. And this is a slide that I've used previously, looking to the past, and we can see there's a lot of non-exchange going on. But then this is the change over here, the introduction of the 5-step model. This is going to particularly affect exchange transactions, contracts. However, one of the first judgments is going to be identifying whether something is a contract or a non-exchange transaction. And I think this is going to be sort of tricky, particularly when we're sort of thinking about arrangements, details, which can move you from one category to another. So what is a contract? A contract is an agreement between two or more parties that creates enforceable rights and obligations. So one of the questions that I always start with is who's paying and who's benefiting? And that's one of the indicators of whether you've got a contract or whether you might have a non-exchange transaction. Membership is going to be potentially the most challenging area, or one of the most challenging areas, because it can fall into both categories depending on what the member is receiving. and what the terms and conditions are. So it may be a contract or it may be non-exchange. So to pull together an example, where a charity provides after-school football clubs in local schools funded by the schools, the children of that school benefit from the club. The charity is providing a service to the school through a contract. In a different scenario, the charity is funded by a grant to improve engagement of school children with football, and they do this by engaging with local schools to provide after-school clubs. In this case, the schools are effectively the beneficiary of the activity, but they're not paying directly for the service. It's coming through a different funding agreement, and this is more likely to be a grant. So the output, in my rather staged example, is the same, but we have one funded as a grant, one as a contract. So these judgments could be quite complex. So where there is a contract, you then need to think about how it's classified. So again, we've said membership might be donations or it might be charitable activities, depending on whether it's exchange or non-exchange. Contracts and grants may be, again, donations or charitable activities. So thinking about both the nature of the agreement, the contract, and what it does is going to provide a sort of more complex starting point.
Okay, so you're going to hear the term 5-step model, I think, quite a lot going forward. So this has been around for a while. If you follow international financial reporting standards, this is really where everything is now starting to align. So where you've got to, based on what Nikki's just discussed, is that we think we've got a contract. And then the challenge is going to be identifying that contract. As Nikki said, the recipient of the value of a non-exchange transaction is not usually the purchaser. If the delivery of the goods and services is solely and directly to the purchaser, then it's more likely to be a contract. The contract usually has commercial substance, defined payment terms for the goods and the services to be transferred. Some potential challenges with identifying the contract, particularly for charities, it's likely to be where you've got a combination of contracts. So you might have contracts entered into all at the same time with the same customer or similar entities, and actually you're probably likely to need to account for them as a single contract if, for example, they've been negotiated together as a single package and there's a kind of an overall single commercial objective, such as providing a number of services for, say, local integrated care board. The consideration is paid in one contract depends on the price performance of the other contract, and that the goods and services promised, or some of them, are a single performance obligation. The other thing to look out for will be contract modifications, which we know happen frequently. And this can be both a change in scope or price. This creates new enforceable rights and obligations, or changes the rights and obligations that already exist. And the modification may be a separate contract if there's additional distinct goods and services, or it may be a separate contract if the price reflects different goods and services. Otherwise, the modification is likely to be treated as if it's part of the existing contract, and any change should be recognised simply as an adjustment to revenue. The second step is to identify any performance obligations. Performance obligations or promises are either a distinct good or service or bundled together. A series of distinct goods or services that are substantially the same, have the same pattern of transfer, such as window cleaning. It's regular. They could be considered as one performance obligation rather than a series of separate ones. And to be distinct, the goods or services promised to the third party must be such that either the third party is able to benefit from the good or services on its own right, or together with other resources that are readily available to them, or the charity's promise to transfer the goods and services is separate from other promises in the contract. If terms are combined, the items are included together as a bundle until the charity identifies a bundle of goods or services that is distinct, or this process results in all the goods or services in a contract being treated as a single performance obligation. Charity needs to understand the promises or performance obligations in the contract, and this is where there's going to be a lot of better understanding between those negotiating contracts and the finance team. Complexities in contracts are likely to include upfront fees, any installations, support services, warranties, training, options for additional goods and services, and there's always going to be agent versus principal considerations. The SORP refers back to FRS 102 for more detail on each of these topics. Importantly, if upfront fees are received, even where they are non-refundable, if they are not in respect of a performance obligation, they become part of the general transaction price, and we recognise this revenue when the goods and services are provided. The impact of this may be to delay the recognition of contract income. The third step is determining the transaction price. So in many circumstances this should be straightforward, but there may be variable elements which need to be considered, and we'll come on to some examples. Charities are expected to take a binary approach. What's the most likely amount? And when considering variable consideration that should amount, that amount should only take into account what is highly probable, which is significantly more than probable. If there are a large number of contracts with similar consideration, an expected amount could be calculated as an average. And if payment terms are deferred, then the charity should calculate separately the impact of financing and include this as interest rather than income. And this is not required where the period is less than a year. So something to bear in mind for long-term contracts. The most challenging element will be variable consideration, and this could include sales or usage-based royalties, refunds, sales with a right of return, and performance bonuses. There are likely to be significant judgments within the estimate for such things as refunds and rights of return, and businesses will need to understand the history of previous transactions and how these may impact the future when supporting their estimates. Any part of the transaction payable to the customer will be accounted for as a reduction in revenue, unless there is a good or service received in return. The reduction in revenue will follow the same pattern as the related revenue.
So coming on to try and put some of those first three steps into a sort of numerical example. And here this is using some of the examples set out in the FRC guidance. So we have entity B, he's carrying out a service for a customer. The contract has a single performance obligation that's satisfied over time, and the transaction price consists of a 500,000 fixed element and a 25,000 variable element, to which entity B will be entitled if it meets the specified performance criteria. At the end of the first reporting period, entity B reckons that they are 90% towards completion of that project. They also think that it's most likely that they'll get the variable consideration that's promised the performance bonus. So what would entity B recognise? So probably we're going for 90% of the contract and 90% of the performance bonus, because they think that they are more likely than not to get that. However, Michael talked about that variable consideration, and there's it's not just probable, it has to be highly probable, and that's not more likely than not. This is a higher bar for variable consideration. So if we take that into account, then perhaps we're only recognising 90% of our 50,000, our base contract. So we're only recognising 45,000. And then as you move into the next period, you should then be recognising your bonus. So we're in this next period. We've got to 100% of our contract. What do we do? So if they've performed and met their bonus, they get to recognise the whole of the 30,000, the 25,000 bonus, and the 5,000 for the end of the contract. If they missed the bonus, they would recognise the 5,000. But I think the key is there from the earlier accounting, you might have been recognising part of that bonus earlier, which is now all delayed. So again, this is going to have an impact on contracts that span the year end, how revenue is recognised, and sort of what that might have in terms of reporting performance. So moving back to Michael and the model.
Yeah, so the next step is to allocate the transaction price. Step 4. So performance obligations within the contract will need to be separated and priced unless there is just the one single performance obligation, or performance obligations are all satisfied at the same time. Estimates to be used for allocation include standalone prices, which is often the best method if each element is otherwise sold separately. Adjusted market prices, so an estimate of the standalone price if you're not providing that service separately. Now this may be based on competitor pricing, comparisons with other services, what you might try and sell the service for on an open market. You might also need to consider cost plus pricing based on an understanding that you're on your own internal costs and the expected margin. And lastly, residual value pricing. So this is likely to produce the worst estimate for apportionment depending on how the sales package has been put together. A change in the price is estimated across all elements on the same basis as was assessed at the inception of the contract. If one element of the performance obligations is already satisfied, that would be recognised directly in income or a reduction in income. And again, Nikki has got an example.
So looking at our example here and thinking about it, we've got an example. We've got standalone selling prices for each element of our bundle of 48,000, and therefore we've been able to calculate the revenue for the wheelchair, the fitting and the service, which we can then allocate to our transactions and our performance obligations. However, if there was a different business pattern, so in our second example, the charity has a practice of bundling the wheelchair and the fitting together for 45,000. So now our allocation needs to change because of our business practice. It needs to reflect what we normally do. So we end up with a balance that merges or allocates together the wheelchair and the fitting, so you've got an allocation of those, and then the service, which gives you again a slightly different apportionment of revenue. Now, in my analysis, that's probably not too dissimilar. However, depending on the figures, that could have again a significant impact, particularly when we go into the next stage of the model, which is how you recognise things over time or at a point in time. Step 5.
Okay, so the final step of the model, as we've alluded to, is how you recognise it. So it's over time or at a point in time. So charity should recognise revenue over time if at least one of the following criteria is met. The customer consumes the benefits as they are received, which could be routine or recurring services. The work to date would not need to be reperformed if another entity were to fulfil the remainder of the contract. If the charity can demand payment for its work done to date, if the charity creates or enhances an asset that the third party controls while it is being created or enhanced. Now, if it's not recognised over time, then it needs to be at a point in time, and that point in time is when control is transferred. So control is defined as the charity has the right to payment for the asset, the third party has the legal title to the asset, the third party has physical possession of the asset, the third party has the significant risks and rewards of ownership of the asset, or the third party has accepted the asset. So for charities selling items in a charity shop, for example, or selling discrete items of service, for example, a counselling session, establishing that a performance obligation had been met at a point in time may be straightforward. Although, just a note, for charities providing more substantial goods and services, that holding back legal title until final payment is made would not necessarily stop revenue being recognised at the stage when the customer is physically taking possession of the item or when the customer accepts the item. It would, as ever, depend on the specific arrangements. Most charities will be recognising services over time, and therefore it is important to identify the best method for measuring progress that reflects its performance in transferring the control of goods and services. For contracts that extend over multiple years, this must be remeasured at the end of each reporting period and will be reflected as a change in accounting estimate with a forward impact only. The charity cannot reasonably measure its progress towards complete satisfaction of a performance obligation, such as it's in the early stages of the contract, but the charity expects to recover the costs incurred in satisfying that performance obligation, then it would recognise income only to the extent of those costs incurred. The charity should adopt the most appropriate method to measure progress in fulfilling performance obligations. And Section 23 of FRS 102 expands guidance on the following methods. So an output method based on surveys of work completed, when the surveys provide an objective measure of the performance to date. An output method based on units delivered, where each item transfers an equal amount of value to the third party on delivery and partly completed items are not significant. An output method based on time elapsed, so when control of the goods or services is transferred evenly over time. An input method based on time elapsed, when entities' efforts or inputs are expended evenly throughout the performance period. An input method based on the costs incurred, so when the method includes costs that reflect an entity's performance to date, contribute to the entity's progress in transferring control of goods or services promised to the third party. An input method based on labour hours expended, so where there is a relationship between the hours worked and the transfer of control of goods or services to a third party. If the charity has a right to consideration from a service user or third party in an amount that corresponds directly with the value to the third party of the charity's work to date, e.g. a service contract in which the charity bills a fixed amount for each half hour of the service provided, then it may recognise as income the amount to which the charity has the right to invoice. The challenge here for charities may be ensuring that they have systems in place to enable them to capture all the information needed here to make an assessment. Is the time on the activities recorded? Are the costs allocated correctly? What is delivered on each performance obligation? And how does that impact on how they should be recognised?
So just talking through another example. So here we've got a charity. I do like my after school clubs. I'm also a governor, so it fits in with that. But as part of the agreement, the charity is providing some equipment to the school and then a series of weekly sessions. It takes a non-refundable upfront fee of 500,000 and 500,000 is paid for the equipment and sessions through the year. The equipment has a standalone value of 4,500 and the sessions have a standalone value of 7,500. So working through our steps. Yep, we've got a contract. We've got an agreement to provide our after school clubs. We've got two performance obligations. We're providing the equipment and we're providing the sessions. And we have agreed a transaction price. So far, so good. We know the standalone prices of each part of the performance obligation, so we can allocate the transaction price on that basis. So then we've got the upfront fee, which Michael said should be recognised as part of the overall performance of the contract. So previously we might have recognised the whole of that 500,000 as our upfront fee, but now we can't do that. We need to consider it in with our other obligations. So recognising revenue, we have our equipment, which we'd recognise when we've delivered it. So we've got our 3,750 there, which we can recognise upfront, point in time on delivery of the equipment. The remainder of that upfront payment, however, we'd have to defer and would release that as the income per session is recognised. And depending on the pattern of sessions, that might be evenly over time if they continue through school holidays, or it might have a different sort of more termly pattern to the release. And again, you'd need to understand the business, the contract and the service being delivered to get that recognition correctly over time. So thinking about another example, and we've got some conference facilities here. So our conference centre provides some services for Smart Limited. It's going to provide a conference in June 2026 for 80,000. Now the contract includes a 12% discount on their conference fee if they return for their 2027 conference. So the fair value of this discount's been estimated at 7,000. So working through the steps again, there is a contract. We've got two obligations. We've got an obligation for the conference and we've got a promise that we will discount future services. Our transaction price is 80,000. And now we need to allocate that. So again, in this example, just to make it easy, we knew what the fair value of the discount was. That would be something that you would need to consider. So we've allocated the transaction price to our conference and our fair value of the discount. So then when can we recognise it? So our conference is fairly easy. We can recognise that income at the point in time that we hold the conference in June 26. But our discount is a promise against future fees, future booking. So we can't recognise that until the next conference is booked, which may be earlier than June 27. But if not, we can recognise that at the latest in June 27 if they haven't come back. So it's these loyalty discounts or bonuses, which are not usually costed or really considered as part of the contract, that may cause the most difficulty in accounting. So again, this is a feature probably more important for profit-making organisations who have performance-related bonuses or sort of are monitoring profit in that way. But because the income has been delayed, the profits are going to fluctuate under this new model from one period to another to a much greater extent than previously. So moving on to Michael and some difficult decisions.
Okay, so in addition to contracts, there's a few other areas where there may be challenges for charities under the new income recognition requirements. So the first one is memberships. So the draft SORP states that memberships received by a charity may be in the nature of a donation, non-exchange transaction, or the member may effectively buy a right to services or other benefits, an exchange transaction. So when the substance of the subscription is that of a donation, the income and any associated gift aid or other tax refund should be recognised basically as the same basis as a donation. If the subscription purchases the right to services or benefits, the incoming resource should be recognised as income is earned from the provision of those services and goods as income from charitable activities. So where the income from membership subscriptions arises from an exchange transaction, the charity must identify how it fulfills its performance obligations to the member, and this will be linked to how the member benefits are drawn down. For example, if an annual member pass to historic gardens allows a member to make as many or few visits as they desire, the charity is satisfying the performance obligations over time by keeping the gardens open. The charity does not know when or how frequently the member will visit, so cannot recognise a known proportion of the income at each visit. It must therefore select a method of recognising income that best reflects the situation. Such a method could be recognising income on a straight line basis over a 12-month period or over the period to which the gardens are open. I suspect the most difficult decision will be deciding whether membership is an exchange or non-exchange transaction in the first instance. The next area of difficulty will be royalties. So this could involve licensing of intellectual property rights such as software, music, or digital images, which are accrued in accordance with the substance of the performance obligations set out in the relevant agreement. The terms of the agreement may permit the asset to be used for a period of time as set out in the licence, and so performance obligations may be satisfied over time. However, some licences may be usage-based and involve variable income relating to the frequency of the use of the asset by a third party, in which case the charity must identify when performance obligations are being fulfilled over time or at one or more points in time. If fulfilled over time, the charity must apply a method to estimate the royalties receivable in the period. If a sales-based or usage-based royalty is provided to the charity, the income is recognised when or as the latter of the following events occur. Subsequent sale or usage takes place, the performance obligation to which some or all of the sales-based or usage-based royalty has been allocated has been satisfied. Next up is long-term contracts. So these involve the supply of services over time with either a continuous performance, for example, provision of like a helpline, or a series of milestones, for example, delivering research and testing contracts. Applying the 5-step model, the charity must identify the performance obligations and whether these are distinct obligations or need to be combined together. The charity needs to identify whether the performance obligations are fulfilled over time or at one or more points in time, and then establish its method for measuring the progress as set out in the contract. As we've already highlighted, any upfront fee payable in advance by a third party for future goods or services is normally deferred and only recognised as income when those future goods or services are provided. And finally, contract costs. So contract costs may be more unusual, but if a charity incurs costs in its effort to obtain a contract with a third party, they may be recognised as an asset if the following criteria are met. The costs would not have been incurred by the charity if the contract had not been obtained. The costs are expected to be recovered from a third party. If this policy is adopted by a charity, it must be applied consistently for all such costs that meet the criteria. Costs that do not meet these criteria will just simply be recognised as an expense. If any of these apply to your charity, there is additional guidance in FRS 102 and in the FRC fact sheets. Overall, there are significant additional disclosures around balances related to contracts and revenue and on the balance sheet. Movements in those contracts, remeasurements, impact of unsatisfied performance conditions, these will all tease out judgments and measuring uncertainties. We will consider the transition and some next steps after our discussion of leases.
Before we get to leases, just a quick overview of what's happening to non-exchange transactions. So essentially, this is a slide from a previous presentation on non-exchange transactions. Looks very much like the one I showed to start with. However, the key difference is that we are losing the word entitlement. So draft SORPs drop that terminology. It's not part of the consideration. We're looking at receivable and what makes something receivable, so the probability of it and can we measure it. Entitlement's only going to feature in relation to dividend income and in relation to grants with performance conditions, so that's where the concept of entitlement is retained. So that's one to watch out for, and again, it's one that I expect will be a change in the way the policy is described, the accounting policy, than potentially a huge change in the recognition of things. But remembering that we're not looking at that. So just thinking about those main elements of non-exchange transactions. Donations we would expect to recognise on receipt, with donated goods and services being recognised at their value to the entity. There's no change in donated items for sale in shops, and donated assets should be fair valued. So that remains fairly consistent. Grants, we're still again looking as to whether the formal funding has been offered and whether there are performance conditions that would delay or change what you recognise. Charities are still not permitted under the draft SORP to use the accrual method of accounting for government grants or capital grants, and there is more emphasis placed on using designated reserves for accounting for capital grants to show how that asset is set aside and then matching the depreciation to show the way that was funded. This is as exists currently, so this is the treatment that can be used. However, there's sort of more emphasis that using designated funds is a way to demonstrate that. So legacies, the guidance has been expanded slightly, but I think there are still considerable levels of judgment, particularly in valuing residuary estates. So there are likely to remain variations in approach. The draft SORP, as Michael said earlier, has required or suggested that there should be disclosure in the trustees report, as well as in the notes to the accounts regarding legacy considerations, in an attempt to make it more clear. However, I think the important thing here is to define your policy and to try and stick to it. So recognition hasn't changed that much. It's considered probable when there's been a grant of probate, or in Scotland a grant of confirmation. The executors have established that there are sufficient assets in the estate after settling any liabilities to pay the legacy, and any conditions attached to the legacy are either within the control of the charity or have been met. So as is currently, if you've got a life interest in the legacy, you wouldn't, if there is a life interest in the legacy or the property, it wouldn't be recognised until after the death of the life tenant. So legacies anticipated in more than 12 months should be discounted. So I think the most challenging part of this, which is probably slightly more emphasised, is determining whether the executors have established that there are sufficient assets to pay the legacy. And given the infrequency sometimes of solicitors' correspondence, executors' correspondence, that can be quite hard to judge when there is actually that sort of decision made that there is sufficient assets to pay that. It may be estate accounts, it may be after that point. So as I said, I think there's still considerable scope for judgment. But overall, the sort of way this has been set out may potentially delay legacy recognition, particularly for those charities who recognise on legacy by legacy because they're more unusual than those that can use a portfolio basis. So final reminder about what limits recognition and what doesn't limit recognition. So essentially, performance-related conditions, and remembering that this is where entitlement does still remain a key element in the judgment. Any other conditions, such as match funding being needed, planning permission being needed, sort of anything else that would stop you going ahead, or a donor-imposed time condition, you can't use it until another stage has been reached, another month has been reached, something specific. However, as always, restrictions don't limit recognition. Submission of accounts and admin elements of managing the grant don't limit recognition, and the recovery of unexpended grant doesn't limit recognition. If there is likely to be a clawback, you would only recognise that potential clawback at the point where you expect it to happen. So if you realise that you're suddenly not going to spend the whole of a grant, you would recognise the provision and adjust income, but you wouldn't do it until that time where that's the likelihood. So that takes us on to lease accounting. So section 20 of FRS 102 on leases follows IFRS 16, and the aim is that it will increase consistency across the different accounting frameworks. Essentially, all entities will be required to recognise a right of use asset, regardless of whether the lease would have been previously an operating lease or a finance lease in old terminology. Accounting for finance leases and lessor accounting doesn't change significantly under the revisions. So the SORP has a whole new section, 10B, which summarises section 20 of FRS 102, sets out the new leasing terminology and walks the reader through the decisions needing to be made for either lessee or lessor accounting. So it's quite structured in its approach. So the first question, as ever, is what is a lease? And what is a lease in the scope of section 20 of FRS 102. So a lease is a contract or part of a contract that conveys the right to use an asset, the underlying asset, for a period of time in exchange for consideration. And this becomes the sort of key feature in looking at charity and non-profit leases, because specifically the SORP draws out that peppercoin arrangements, whilst they may be considered to have the legal form of a lease with nil or nominal consideration, are unlikely to meet the FRS 102 definition of a lease. So these lease arrangements are therefore considered to be a form of non-exchange transaction, and we're back into our revenue recognition and our recognition of donated services and assets. So there's a whole question to start with here, which is my lease an exchange transaction, or is it a non-exchange transaction or a lease with a non-exchange element? So the SORP doesn't provide the full guidance on the accounting. It does refer to FRS 102. And as I've said, it is a sort of useful walkthrough of what you need to do. However, if you're thrown back into the revenue recognition, again, you need to understand the donation, whether it's an asset, whether it's a service, and then how you would value that, whether it's fair value, whether it's at the value to the charity. So there's quite a lot of questions coming out of the exposure draft. Intergroup arrangements, again, where you've got those the subsidiary may pay rent to the charity, that's unlikely to be a lease in the context of this section 20. There are some exemptions available in FRS 102, and those are leases which are short-term, less than 12 months on exception, with no purchase option, and low-value assets. And again, we've got examples of things that can never be low value, and the SORP in line with the FRS 102 basis of conclusions includes also some assets which can be low value, just to help in guiding that. So low value is not based on materiality to the entity, it's based on the essential value of the assets that's being considered. So discussion I had only yesterday about a coffee machine, but trying to decide whether some of these assets are low value or whether they're in the never low value category will be, again, a matter of judgment. Charities are going to need to sort all, or you are going to need to sort all your leases into those which might meet that low value short-term categorisation, or where they are going to need to become a right of use asset. If you are still deeming them to be low value or short term, disclosures are still required in the same way or similar to the operating lease disclosures currently. So you can't just put them entirely to one side. They still need to be logged and accounted for. Key features of lease accounting, as I said, are covered in the SORP, and that does start with consideration and an agreement that gives the lessee the right to control the use of an identified asset for consideration. And that is going to be the key to understanding which path you're going down in terms of recognising this. Now, just to flag up, leases may not always be obvious or known to the finance department. If they're held in operating departments who manage the budget, include the lease costs, the lease details may be out there. So one of the first challenges, I think, is going to be to collect all the leases into one place and understand the terms, understand the length. For some leases, it may be useful to talk to your supplier. So looking on the Octopus Car website, which does the electric vehicles, there's some guidance on the accounting and the need to recognise a right of use asset for the cars used by employees as part of their benefits package. So again, leases may not always be obvious, and they may be part of another arrangement, another contract. So trying to identify all of the leases that you need to account for will be the first step. Once you've got your leases, the next step is to recognise whether you have an identifiable asset. So if the supplier has a substantive right of substitution, there's no identified asset and no lease. However, the right to substitute is only substantive if the supplier can practically change the asset during the contract and if they would benefit from doing so. So there needs to be an economic advantage for the supplier to change the asset that's being used. An identified asset is expected to be physically distinct, or if not physically distinct, so if we've got fibre optic cables, they can only be an identified asset when they're substantially all of the capacity of the asset is being used by the charity. So again, there's some questions of judgment in whether your agreement does contain a lease. The agreement will be a lease when the lessee has control and the right to direct the use of the asset and obtain substantially all the economic benefits from that use. And that's for the period of the lease. So benefits include the ability to generate cash or to use an asset to further the charity's objectives. A contract may have multiple components, so you may have a lease and maintenance all wrapped up in one contract. Again, ideally, you want to separate your lease and your maintenance components. However, that might be a challenge. So there is a practical expedient, if it's too difficult to separate, that you can account for the whole contract as a single lease. However, that would create a higher right of use asset and a greater liability if you can't separate out those components. So to value the asset and the liability, the charity needs to understand the start date, so when control is passed. So that includes any payment holidays, rent-free periods at the start, and the period of the lease. And that sounds really simple. But the period is the non-cancelable period of the lease, but it can be altered by termination clauses or extensions that the charity is reasonably likely to take. So we've got another element of judgment here because it's the reasonably likely, and that needs to be based on sort of business practice, practicality, how central that lease is to operations. So again, there needs to be a sort of proper rationale for whether you are reasonably likely to either take an early termination or to extend the lease, altering the term. So the last element of the liability calculation is the discount rate, and save till last because this is probably the element where there is the most judgment. The best rate to use is the rate implicit in the lease, which is a mathematical calculation that causes the present value of the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying assets and the initial direct costs of the lessor. Now, there are some elements of that transaction which you're going to know. You're going to know what your lease payments are, and potentially you know what the fair value of the asset is if you've been deciding whether to lease or buy. But the residual value and the lessor direct costs may not be so difficult to do. So if you can't get that rate, you then look at lease by lease whether you can get your lessee's incremental borrowing rate or the lessee's obtainable borrowing rates. So these are the rates that you would get if you were trying to borrow money with a similar term, similar security over a similar time. The challenge of these is that if you are not and don't have other borrowings or lendings, or don't have security, obtaining that rate is going to be a challenge. The FRC has suggested that banks may help charities in identifying these rates. So again, if you have a good relationship with your bank manager, you can ask the question. However, for charities, and this is only for public benefit entities, there is an additional rate that you can use if everything else fails, which is the rate of interest otherwise obtainable by the charity on deposits held with financial institutions. So this is just for public benefit entities, and I feel might be a very practical expedient when trying to identify the discount rate. So moving on, this is how we're then going to do the calculation. And the first part of any calculation is understanding the costs, which mainly drive the liability calculation. So again, we're measuring the finance component of the lease payments. And there's going to be lots of elements in that. You've got your payments, but also any lease fixed payments less lease incentives receivable, but you may need to add variable lease payments if they are based on an index or a fixed rate that's known at the start of the lease. If there are any amounts that you're expected to pay under residual value guarantees, if there are any options, and an excise price, if you're reasonably certain, again, to exercise that option, you would build that into your calculation at the very start of your lease. And again, if you're anticipating payments or penalties for terminating the lease, again, if you'd need to reflect those if that was your consideration and the sort of link to the lease term. So payments made at the start of the lease or prior to it are part of the cost of the right of use asset, but not part of your lease liability. So for that and for the other elements that you can see that are added into the right of use asset, including any donations, dilapidations, adjustments for the payments we've made up front, we would expect the right of use asset to have a higher value than the liability. Handing over to Michael.
Thanks, Nikki. So thankfully we're almost there. So thank you for listening so far. So what do you do once you've got that asset on your balance sheet and the liability? So like any fixed asset, it will now be depreciated over the lease term or potentially the life of the asset if, for example, you've got a purchase option that is reasonably likely to be exercised and was included in that original calculation. As with any fixed asset, it will need to be assessed for impairment, and then there will be an adjustment if there is a subsequent adjustment to the lease liability. So when we're considering the value of the liability, So any variable lease payments that weren't included when we measured the lease liability, for example, if you've got a turnover-based rental charge, would be recognised in the profit or loss also for over the period in which the events that trigger those payments occurs. Otherwise, changes to the lease term, lease payments and other conditions of a lease will fall into two categories. Changes within the existing terms and conditions of a lease, referred to as a reassessment of the lease liability, and changes to the terms and conditions of the lease, referred to as lease modifications. So a reassessment of the liability will need to occur when there are changes in the estimates that we use to build the liability. For example, if there's a decision made to take up an option to extend the lease, that would need to be reassessed using the new lease term and the new appropriate discount rate. Reassessment would also occur when, for example, the amount payable under a residual guarantee or a change in the future lease payments arising from a change of index or underlying rate occurs. In this case, the value would be recalculated with new values, but typically the same discount rate, unless the change resulted from a change in the floating interest rates. Lease modifications are when the underlying lease terms change. If, for example, an additional asset is added to the lease, then it is likely to be treated as a separate lease. If changes remove the right of use and decrease consideration, or just reduce the consideration, or increase the consideration but that increase is insignificant to the whole lease value, the recalculation may use the same discount rate. If the lease modification does not fall into one of those categories, then you will need to use a revised discount rate. So this slide is just a reminder that each key decision and assumption will need disclosure, and as well as disclosure under these new requirements, we will continue to disclose current operating leases for those short and low value leases, so they can't simply be forgotten. The basis for all the disclosures should be documented as you work through each calculation. So to consider a practical example, Charities entered into an agreement to use one floor of a 5-storey office building for 3 years. The other 4 floors are occupied by the lessor, which is a commercial business. The market rent for this floor is £120,000 a year. So what else do you know? The lessor states that as part of its CSR responsibilities, it's decided to give the charity a 50% discount on the office space. So instead the charity is going to pay just £60,000 a year. If the arrangement had not been available, the charity would expect to pay £72,000 a year for office space elsewhere. So this information available to the charity indicates that there is a non-exchange component in the lease that Nikki referred to earlier. So where the charity determines that it is a facility that it has received under this arrangement, it is the value to the charity of the office space that is really important. So the non-exchange component is £12,000 a year, which is the difference between the value to the charity and the payment being made. The charity will continue to recognise the income when it has received the receivable, which will usually be at the commencement of the lease, but maybe over time of the lease depending on the exact terms of the arrangement. So where such arrangements do not meet the definition of a lease, in addition to accounting for the nominal payments due under such arrangements, charities do need to consider the benefit that they're receiving and how that should be measured and accounted for. Module 6 should be referred to for further information on how to account for donated assets, services and facilities. Charity must consider the substance of the arrangement and how to account for it, consideration of the use of the asset, facility or service, and whether the charity would have purchased it if the nominal arrangement had not been entered into will be helpful. For example, if the arrangement means that an asset is available to the charity to use to carry out its activities, the charity will need to identify the fair value of that asset and account for the donated asset in line with the treatment described in SORP Module 6. If the arrangement means that a facility or service is now available to the charity, the value to the charity of the facility or service is used and a donation recognised for that amount. Again, further details can be found in SORP Module 6. So, an example given in the SORP. So similar to the one before, charity expects to pay £72,000 for an office space elsewhere. Maybe that's where they've previously been and that's what they've paid. This time they're getting the full peppercorn rent, a nominal £10 a year. So what do you do in this circumstance? Well, broadly the same. So this time the £10 nominal value really means it doesn't meet the definition of a lease because there's no substantive consideration being paid, and the difference between the payment and the value being received is what is considered as a charitable donation. But in this circumstance, there's no right of use asset or liability that goes on the balance sheet. And finally on leases, really just to summarise the impact, there's a few publications from listed companies when IFRS 16 came in a few years ago, which may be of interest to people. But the overarching change is that there's no impact on what you're doing or the cash requirements for the charity. However, there is a significant impact on the financial statements. There's going to be a big change in the cost base. So your rental charge, which has previously been included, will no longer feature and is instead replaced by depreciation and the interest charge. This is where this could be less or more than what you previously had as a cost. It front loads the impact of long leases, so there is a reduced impact towards the end term of a lease, and will impact obviously some organisations far more than others. For example, a charity with a significant number of charity shops. What it means for the wider landscape is that leases for more than 5 years are becoming less common, because the financial reporting considerations are being taken into account when drawing up leases. And obviously additional work is going to be needed where peppercorn or below market rents are in place, and you will need to identify that underlying interest rate. Things to already start to consider will be the impact on your budgets and forecasts. For example, if you've done a 3-year forecast and you've got a rental charge in that, then you're going to start to have to think about the impact of the depreciation and start to think of the liability costs now. It may impact fundraising, particularly for capital projects, and it's something you should now be considering if you are entering into or negotiating new or existing leases. Back to Nikki.
So just a reminder, as we really do get into the last section, which is thinking about transition and next steps, is please put any questions that you've had in the comments box, and we will try and pick them up at the end of the session. But we're on the last section, so thank you very much. And back to Michael.
Okay. So, considering revenue, once the charity has developed an understanding of what contracts it holds, the next decision is really how to transition to the new standard. So the standard provides an entity with a choice, so you can do a full retrospective approach. So under this approach, an entity will need to restate their comparatives, remembering that we're now almost halfway through that comparative period if you have a December year end, as that comparative period would have started on the 1st of January. There's a modified approach. So under this approach, an entity does not need to restate its comparatives, and the cumulative effect of initially applying this section are recognised an adjustment to the opening balance of retained earnings. This approach only applies to contracts that are not completed at the date of the initial application. So each of the above methods will have their own merits. For example, the modified retrospective approach may be considered a more efficient way of adopting the standard rather than restating an entity's comparatives. Conversely, where it is anticipated that the adoption of the standard will result in significantly different revenue recognition, an entity may decide that applying a full retrospective approach would ensure more comparability in the entity's financial statements. Whichever transition method is selected, it is important to begin to plan early and communicate the transition plan to key stakeholders so that the impact of transition is fully understood. A good example of a report on leases is one published by Tesco's in 2019. For the leases transition, there are some additional exemptions and practical expedients around leases. For example, if you already have a calculation of the lease value, then that value can be used on transition. If you've accounted for the lease as an investment property at fair value, then no adjustment is required. If your lease is expiring within 12 months of initial application, it can be excluded from the balance sheet model. Unlike the revenue transition, there is no option. All entities will make an adjustment to the opening balance of reserves at that initial date application. So for December year ends, that will be the 1st of January 2026. So what should you do to prepare for change? So you need to review your current lease arrangements and establish whether any leases are short-term or low value and whether they are finishing within 12 months of transition and can therefore be excluded from those initial calculations. Similarly, for contracts, charities need to assess the impact on each of the income streams and consider the likely change in accounting for current contracts and income streams and identify both the amount and timing of income using the 5-step model. So steps should include identifying all your contracts and your non-exchange transactions, considering your performance obligations, whether you've got many or just one, identifying what information is needed to allocate the transaction price. Are estimations required? Do you offer discounts? Is there a right of return? Do you have loyalty schemes? Understanding what contracts will be in progress at the year end. If obligations are recognised over time, what method will you use? Input, output, and do you already have that information? Again, for transition, charities will want to focus on contracts which will continue over the year end. Contracts finishing in the year do not need to be recalculated. Management will need to ensure that all elements of the organisation are aware of the changes and the need to centralise both contract information and other information that will enable leases and contracts to be measured. For contracts recognised over time, this would potentially include timesheet and cost information or ways of identifying milestones and deliverables. Once charities have considered what additional record keeping is needed, they then need to reflect on whether the systems can collate that information, whether they can be amended or replaced if needed. The method of transitioning will need to be decided so that the pertinent information can be collected. And finally, you will all need to consider whether the change in asset position will impact on any current or future borrowing or financial arrangements. Whether income recognised may push you over thresholds or whether a change in balance sheet value will require the charity to have an audit where it is not already required to do so.